Hello and welcome to episode 2 of the 2014 ISDA Credit Derivative Definitions in Focus. Our series looks at the principal changes made in the 2014 definitions. Last time we focused on the governmental intervention credit event and asset package delivery provisions. This time we are looking at the restructuring credit event. Almost every culture has the concept of a bogeyman, a mythical creature which strikes fear into children and scares them into good behavior. He personifies terror. In Spanish-speaking countries, he is El Coco. In Germanic countries, Butzemann, and in Persian countries, Lulu. In credit derivatives, he is the restructuring credit event. There are many times which it is thought he has been tamed only to launch another problem in the market. In my earlier overview lecture, also available on the Mayor Brown YouTube channel, the 2014 ISDA Credit Derivative Definitions, The Path to Here, I discussed some of the problems in the restructuring credit event which had been exposed over time. Let's now scrutinise that history and background further. When a corporate or sovereign finds it's unable to pay its debts when they fall due, this can either be because it simply does not have enough money to do so and is unlikely to do so in the future, or because it has had a cash flow crisis, that is unable to pay its debts now, but with some adjustment of maturity dates, modification of interest rates, or rolling over of loans, it will be able to meet its obligations in the future. Corporate and sovereign debt restructurings are regular occurrences in the capital markets. Restructurings are rarely carried out, though, with the credit derivatives market primarily in mind. Not unless the creditor banks or bondholders involved in the restructuring have also hedged their positions with credit derivatives. Restructuring is problematic as a credit event. Firstly, if credit derivatives are intended to isolate and separately trade credit risk, with payments made from seller to buyer intended to reflect a decline in the creditworthiness of the reference entity, then the restructuring which prevents a further decline in the creditworthiness of the reference entity, for example, perhaps through the lengthening of the maturities of its bonds and the reference entity granting security over its assets, is arguably a contradiction, especially if in the long term the reference entity's creditworthiness improves. Other than in the case of sovereigns, the fact that a reference entity does not file for bankruptcy demonstrates that its directors, shareholders, and creditors believe in the reference entity's long-term financial health. The second reason, and the principal reason before the financial crisis, why the restructuring credit event became a problem credit event, is what became known as the moral hazard of the cheapest to deliver option. Restructurings do not always relate to all of the reference entity's obligations. The creditors of restructured obligations are likely to seek greater protection for agreeing to any restructuring, such as the reference entity granting security over its assets. This can mean that a restructuring obligation trades at a much higher price than those obligations of the reference entity which have not been restructured. Following a credit event, the reference obligation valued at auction or in cash-settled transactions, or the deliverable obligation delivered in physically settled transactions, need not be the restructured obligation. Once again, this can lead to a contradiction. The event which has occurred to the restructured obligation, which represents the decline in creditworthiness of the reference entity, may have a lack of correlation with other obligations which are now deliverable or being valued to establish the final price for settlement following the credit event. A third area of weakness which arose in the restructuring credit event arrived between 2003 and 2014 when the objective nature of the 2003 credit definitions caused tension in the Greek crisis. For a restructuring credit event to occur, certain clear conditions had to be satisfied. These did not allow scope for a subjective approach by the ISDA Determinations Committee, i.e. meeting or breaching them in spirit. This in turn provided a great opportunity to the politicians and regulators and their lawyers to try to arrange restructuring of Greek debt in such a way so as not to trigger that event. Politicians became worried that the triggering of the restructuring credit event in respect of Greek debt would set off a downward spiral for Greece, resulting in the country's exit from the Eurozone and a possible contagion of other troubled countries such as Spain, Portugal, and Italy. Therefore, they relied on the provision in the restructuring credit event definition that an event is only triggered if the restructuring binds all holders of the relevant debt obligations. A restructuring which did not bind all holders of Greek debt would therefore not trigger a restructuring credit event. In particular, a restructuring where the bondholders volunteered to take a haircut on the principal value and interest rate of their bonds, together with an extension of the maturity date, would not be a restructuring credit event. With the large majority of Greek debt owned by banks and other governments, regulators and governments encouraged those banks in the European Union to exchange the Greek bonds they were holding for new bonds worth less than half the value of the original ones. If more of the private investor base had caved in, then the Greek government would not have had to activate the collective action clauses, and a restructuring credit event would not have occurred. Even though a number of investors refused to proceed with the voluntary exchange, forcing a different court of action, the weakness in the credit definitions had been exposed. An argument has been made that the number of banks agreeing to the Greek debt exchange suggests that the restructuring would not be voluntary even without the use of the collective action clauses in the bonds. It is difficult to label a decision as voluntary when a number of banks have been coerced to make it by their regulators. The focus on the decision binding all holders appeared to neglect the fact that some of the bondholders were effectively forced to agree to a restructuring, and the argument that they should have a right to receive protection under their CDS contracts is compelling. Following a credit event, an auction organised by ISDA determines the final payouts that the buyers of CDSs will receive under their contracts. During the auction, dealers are asked to bid on a series of deliverable obligations, which generally are the reference entity's loans or bonds. In the majority of previous auctions, deliverable obligations were the obligations of the entity which were due at the time that the relevant credit event occurred. But the original Greek bonds had already been exchanged by the time the auction took place. The problem was that each old Greek bond was exchanged for a bundle of new Greek bonds, EFSF notes and GDP warrants. However, the credit definitions only allowed new Greek bonds to be delivered at the auction, which did not reflect the economic reality. This also meant that a buyer of protection under a CDS could have suffered much bigger losses on the old bonds than it would be actually compensated for under its CDS. Fortunately, the auction price for the new bonds was trading at a similar level to the price of the old bonds before the exchange. As a result, the payouts that the protection buyers received under their CDS contracts more or less reflected their actual losses. However, the problem was highlighted. It is arguable that these fundamental problems should mean that restructuring should not be a credit event at all. However, because restructuring can be so closely aligned with credit worthiness or is used as an escape route from actual defaults, its continued inclusion as a credit event has always been inevitable. So the restructuring credit event remains in the 2014 definitions. It is in improved form, hopefully ready to battle anything thrown at it, and it still holds its place at Section 4.7. It continues to provide in Section 4.7a for 5 specified events to occur to an obligation, any of which can then constitute a restructuring credit event. These are an interest payment or accrual reduction, a principal or premium reduction, a postponement of payment of accruals or interest or principal or premium, a change of an obligation's priority of payment causing its subordination, or a change in currency of interest or principal other than to a permitted currency. How have these 5 principal points changed since the previous version? Firstly, an interest payment or accrual reduction is now specifically deemed to include by way of redenomination. The effect of potential redenominations where there were fears of a euro breakup had tested the robustness of the definition. The central tenet of a credit derivative is to isolate and separately trade creditworthiness, and had a country left the euro, widespread redenominations of corporate and sovereign bonds could have caused havoc. The second change is for a principal or premium reduction to also specifically be deemed to include by way of redenomination, and for the postponement to be for any redemption, not just scheduled dates and maturity dates, which captures a broader range of structured securities. Thirdly, where there is any change in currency of interest or principal, the previous reference excluded redenomination to a permitted currency. This was defined as G7, later G8 currencies, or the legal tender of OECD countries having a long-term debt rating of AAA or equivalent by the rating agencies. The new definitions provide a carve-out only for redenomination into the currencies of Canada, Japan, the US, UK, and the euro. Successor currencies are included, and following the risk of euro breakup in 2011 and 2012, a successor to the euro is defined as the currency which succeeds to and replaces the euro as a whole. The change makes it easier to trigger a restructuring credit event where a single EU member state leaves the euro, putting all member states on an equal footing. Previously, if any of France, Germany or Italy, the G8 members, had left the euro, this would not have been a potential restructuring credit event, but for example, Spain, Netherlands or Austria would have been. The more substantial modifications to the restructuring credit event are made to section 4.7b, which sets out the exclusions from what constitutes a restructuring credit event. Previously, these exceptions applied where the restructuring event does not directly or indirectly result in the reference entity's creditworthiness or financial condition deteriorating, or an EU member state converted its currency to the euro, or the restructuring events occurred because of an administrative, accounting, tax or technical adjustment in the ordinary course of business. Under the revised 2014 definition, where a member state government triggers a redenomination from euros into another currency, this will not trigger a restructuring credit event where there is a freely available market rate of conversion between euros and the new currency which existed at the time of redenomination, and the redenomination does not result in a reduction of principal, interest or premium. Without this exception and the other redenomination changes mentioned, a restructuring credit event would only occur if there was a deterioration in the creditworthiness of the reference entity combined with a redenomination from euros into another currency. With the new amendment, no deterioration in the creditworthiness of the reference entity is required for the credit event to occur, where a member state government triggers a redenomination from euros into another currency and the value of the new currency results in a lower amount of interest, principal or premium payable by reference to the new rate of exchange. So where a strong company is present in a weak economy, and although the creditworthiness of the company remains strong, the surrounding country environment means that there is a macro decline in the value of its obligations due to weakness of the new currency, whilst the micro creditworthiness of the company, i.e. its ability to repay debts, remains strong, this will be a restructuring credit event. Where though the new currency is as strong, and so is the company, there will be no restructuring credit event. And where there is now a weak currency and a weak company, we will also have a restructuring credit event. Previously, the position was unclear. The new section 4.7 also makes two clarifications. Firstly, in relation to multiple holder obligations, and secondly, for bond exchanges. Where multiple holder obligation is specified as being applicable in the relevant confirmation, a restructuring event can occur only in relation to a multiple holder obligation. Multiple holder obligation is defined as an obligation held at the time of the restructuring credit event by at least 4 non-affiliated holders and whose terms require that 66.66% of the holders consent to the restructuring. The role of this provision is to prevent a creditor in a limited creditor group agreeing to a restructuring which is not advantageous, safe in the knowledge that it will not suffer the consequences of what is agreed to because it has hedged its credit risk by entering into a credit derivatives contract. A shortcoming in section 4.9 was identified soon after the publication of the 2003 definitions. It is market practice for Eurobonds to require that 75% of the bondholders vote to approve a restructuring and fix a meeting's quorum at 75% of those bondholders. This means that any market standard Eurobond which restructures could be approved by only 56% of the bondholders and would then fail the multiple holder obligation test. ISDA addressed the problem in the May 2003 supplement, which provided that a Eurobond will be automatically construed to be a multiple holder obligation. In the 2014 definitions, a new section 4.7c provides that multiple holder obligation captures the underlying obligations for which the reference entity provides a guarantee. Here, the various events constituting a restructuring credit event apply to the underlying obligor, and the carve-outs which are set out in section 4.7b apply to the reference entity. Section 4.7d also provides a new limb to cover where an obligation is a bond which is subject to an exchange. The provision clarifies that the terms of the bond immediately prior to the exchange should be paired with the terms of the bond immediately after the exchange to establish whether a credit event has occurred. As the most controversial of the 7 credit events, restructuring has faced the toughest market tests in the 15 years since the 1999 definitions were published. The 2014 definitions leave us with the same 3 variations of the restructuring credit event as in the 2003 definitions: full restructuring, modified restructuring, and modified restructuring. As a reminder, full restructuring, or Old R, was selected by simply specifying that the restructuring credit event applied in the confirmation. Modified restructuring, or Mod R, was selected by specifying restructuring maturity limitation and fully transferable obligation applicable below restructuring in a CDS confirmation. This aimed to reduce the moral hazard of what is known as the cheapest to deliver option, which is where, following a credit event, a purchaser of credit protection delivers particularly cheap, long-dated defaulted bonds. It is used mainly for North American corporate reference entities and is not among the standard elections for sovereign credit derivatives, with the exception of Australian and New Zealand sovereign reference entities. Finally, modified restructuring, or Mod R, which is a market standard for European corporate credit derivatives, is selected in the confirmation by specifying modified restructuring maturity limitation date and conditionally transferable obligation applicable below the restructuring credit event election. The 2014 definitions make some changes to event determination dates for the restructuring credit event. In the main, these are clarifications. In a standard transaction where there is auction settlement with buyer or seller as notifying party, the event determination date is determined in accordance with section 1.16a and is the notice delivery date or the credit event resolution request date. There is a split between credit events which are not MMR restructurings and those that are MMR restructurings, with the latter requiring a credit event notice. For non-standard credit derivative transactions, i.e. transactions which are non-auction settlement or buyer-only notifying party, or both, the event determination date is determined according to section 14.1. Here, for MMR restructuring credit events, the notifying party must deliver a credit event notice prior to the exercise cutoff date. For non-MMR restructuring credit events, these must be triggered prior to the end of the DC announcement coverage cutoff date period. The period here has been reduced from 21 to 14 days following a no-auction announcement. It is now also no longer possible to bilaterally trigger once the DC announcement coverage cutoff date has passed. So all in all, the changes to the restructuring credit event are complex. They had to be to deal with all the issues thrown up in the last 10 years. Is that the end of the changes? History tells us that new unforeseen circumstances can arise. For now, though, the changes are an excellent improvement. Thank you for viewing. I look forward to seeing you for the next episode.